Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome back to another episode of the Property Nerds podcast. And if you've missed it, Jack and I have been the new co-hosts together of the Property Nerds podcast, kicking off, 2 episodes ago. So this is our 3rd episode together. And it's been good jumping into the world of finance once again, property, research papers, all coming together with more finance strategy as well. And that's been big as the theme for 2024 and onwards, that we don't want to just talk property data, but we want to actually unpack finance data and finance strategy. Because if you get your strategy right in finance, it's the old thing, or the old saying, right, Jack? It's property is a game of finance with a few houses thrown around. So that's definitely it. But in terms of today's episode, I wanted to let everyone know about something special. And this something special hasn't been announced on any of our last 2 episodes, but I promise you'll be a lot of value to those seeking support on finance strategy as a core area of focus. So as you know, I've got Jack here on the episodes here with me as my co-host, and Jack's team at forakerfinancial.com.au. Now they've actually, by the way, for anyone wanting to spell that, it's FOURACRE financial.com.au. For anyone who wanted to go, okay, all this stuff on the mic sounds great. It's great to watch this, learn about this, but I want tailored finance strategy from the man himself. Mm-hmm. Then jump on forakerfinancial.com.au, where you can actually have a chat with Jack and talk through finance strategy, figure out what's best for you. This isn't just the simple basic stuff that all the brokers talk about. What's your interest rates now? How much is the loan amount? Thinking of just the cha-chings in their eyes of what they refinance and move over. That's not how Jack works. Jack will be understanding much, much deeper thoughts in terms of the structures of where the loans are at, which banks you're with, money in offset, money out of offset, figuring out how to best use it all. And Jack's put the special offer out there to say that, hey, if you're wanting to speak finance strategy, reach out to Jack at forakerfinancial.com.au, just so you can have a personalized chat with the man himself. So very rare that happens, and to go just away from the finance initial chats, but go deep into strategy with someone. And so you're going to get that for no cost sitting with Jack. But spots are limited. I don't think he's going to be able to take on too many appointments based on how popular he already is. So when it comes to that, please do reach out to Jack so you can have a chat on finance strategy. Because this episode, we're going to talk some things on finance strategy. Other than that, we're heading into Christmas break soon. I know it sounds crazy because it's like not even December yet. But in the property world, this is where times get pretty crazy. And going into property investing, I can remember I've actually made a fair bit of purchases in November, December, and January personally. I find that making them around that time offers some negotiating opportunities. So that was just a quick tip from my thoughts to let everyone know that this is a pretty good period of the year to buy property when it comes to November, December. It is the hardest too from a stock levels because it starts to fade away, but from a negotiation levels, as you move into November, December, things start getting in your favor the closer and closer you get to Christmas break. So that was just the 2 things I wanted to shout out before we get into today's episode. But in terms of today's episode, the hot topic's been on negative gearing and CGT. I can't believe they didn't learn their lesson in 2019 after getting hammered, and just bringing that up as a political topic to begin with just means that it's going to get scrutiny, it's going to get a lot of backlash, it's going to get a lot of thoughts, because there's so many flow-on effects that people don't think about when thinking of this policy. So we're going to go into the negative gearing, CGT thoughts, what's being proposed, what's being thought of, and even just talk about our thoughts, both Jack and I, on this podcast today. And actually just break down, which is something you want to stay till the end for, how servicing calculations for borrowing power even factor in negative gearing, like how that works. Is it a difference maker? Is it not a difference maker? We'll uncover that, bit of a shock surprise to come. And how negative gearing gets factored when you use, other mechanisms of using in borrowing capacity, considering your own cash and offset monies and looking at that in a deeper view than more typically do, which is me coming back to that finance strategy. So we're going to nerd out. That's what we do at the Property Nerds. Mm-hmm. But mate, Jack, what's happening your way and your thoughts when it comes to this whole negative gearing thoughts and bringing that down and potentially getting rid of it again or moving it, CGT? What's going on?
Yeah, I mean, you said it before. It's a good way to lose an election. They just keep bringing it up. But yeah, like if they change the way negative gearing works for owning a property in your individual name as well as capital gains tax, my immediate thought was, okay, are they going to change that for how trusts work as well?
Yeah, good point.
If you own a property in a trust, you can't negative gear, like you can't utilize the negative gearing effect within that trust against your personal income.
Yeah.
What happens is the negative gearing aspect just gets built up and brought forward to offset future positive cash flow in future years. But if they change that for negative gearing in your personal name, they might have to change that for trust as well. The same goes with capital gains tax. When if you own a property in your personal name, you sell an investment, you can't hide from the capital gains. It's just whoever's on title goes straight to you. But if you have a property in a trust and you've got beneficiaries in that trust that you can distribute the capital gains to and distribute to the lowest income earner, if they scrap that as well or change that, there's a lot of existing trusts that have set up years and years ago, strategies that were implemented by accountants years and years ago. It's just a nightmare. Like
that would also mean like just the flow-on effects would be nuts. Like imagine all the trusts and the accountants that have done annual tax returns on them. Like, do you think it could even just equal mass closures of trusts, right?
Yeah, they'd have to grandfather it, honestly. They typically, they say that because when things like this get brought up, they say, no, we'll keep it going for existing trusts, but for anything new after a certain date, like it's changing. So, but it's pretty significant changes, man. And yeah, it's a good way to lose an election.
Yeah, I get you. And so on the trust part, what you've raised is a pretty important point because there's two ways to look at that. Firstly, yes, if that goes there, then what's the point of keeping a trust outside of maybe some asset protection layers?
Yeah.
But all those things disappear from people, parking for future positive cash flow to come off it, but then also people having that CGT distribution if that's going to be removed too. That removes a big part of it. But then there's the opposite part. People think that negative gearing is going to massively shake up all the property investors that are claiming all this money. People don't realize that, only a small percentage of property investors actually own a lot of properties. And even if, say, people go, but hold on a minute, the statistics of ATO don't factor in trusts because the whole, less than 10% of property investors own 3 or more properties. And Arjun, that's not fair. That data doesn't consider trust. Well, take this for a moment. The trust data doesn't have tax negative gearing to your own personal incomes. Yeah. So like the whole people that you're trying to put this against are likely savvy investors putting things in family trusts.
Yeah.
And as a result, they're not claiming this, crazy rich making negative gearing thing that all the wealthy are doing and suddenly is, cranking up the property market. Well, they're not even claiming that in their individual names. So that means you're left with not so much the sophisticated investors, but more those mums and dads who are, in typical occupations or maybe in occupations that don't, have the millions of dollars of incomes that business owners do because they, again, are putting in trusts. So it's like, who are you trying to get out here, right?
So ultimately, what I think, right, if they're trying to remove negative gearing, what they're basically saying is that we don't want you to be able to claim this as a tax deduction, right? Because they don't want to give you that money back at tax time. They're just trying to get more revenue for themselves, really. That's what it looks like. Unless it's a give or take, but it seems like it's all take, no give.
Yeah, and see, this is interesting, right? For me, it's like, here's where I'll go. If you don't want negative gearing and say from a government perspective, look, take it away from us if you're just going to build all the social housing, right? And like if social housing's at a level, think about the core reasons of why the support is even there for property investors to make these deductions. It's because they're providing, economic benefit by providing rental housing.
Yeah.
And many people sometimes make the mistake of thinking, everyone wants to buy. And because you're an investor, you're blocking people from buying. What people don't recognize is that, like, when I move from, say, Sydney over to, say, I'll just use a city, random city, Dubbo. And when I go to Dubbo, I might be going there for an opportunity to work, gain skills, be in a city to go for a job that I wouldn't have available in my city, or be in an industry, whether it be the wildlife in the zoos or whether it be certain agriculture that maybe doesn't have the opportunity in Sydney. But it might not be forever. And I might want to go there for a certain time in my life and experience a phase. If investment properties aren't there, Are you telling me I'm going to be staying at a hotel the whole time just because I don't want to buy a place? Or are you now going to force me to actually buy a place to live there, and I have to buy wherever I go for work? Then I have to sell and I have to commit to this home. People don't want to do that. Sometimes people forget that from this huge housing affordability conversation and negative gearing and taxes and how that comes into it, people forget that not everyone's in certain housing all across this country to want to live there. They actually want to rent there for certain life decisions. People who maybe have a situation where it's not just work related, it's studying related. I want to go and study and then maybe get my, part-time job, or maybe get a casual job while I'm there studying in that city. Do you suddenly go, well, I'm going to buy a home here? Well, no, because you're studying, you're in part-time or casual jobs, you're not going to be able to, afford a home. But even if you say they were affordable, you might not want to buy a home there if you feel like you're only going to be there for a few years whilst you study. So there's so much audience out there as well that actually isn't in that home buying area, and people forget that they need housing in other ways. And if the social housing's not there, investors need to be there from a rental housing perspective. But just on the negative gearing part once more, I want to just get your thoughts, Jack, on servicing. I'm of the opinion it would make a bit of a difference, right, to how home loans get serviced, because banks factor in negative gearing calculations in their lending criteria. What does that do to the lending side of things?
Yeah, so most lenders, vast majority of lenders, when you have investment debt that's in your personal name, obviously that's negative geared debt. So there'd be a section within lender calculators where you can either tick a loan as an investment loan or add in investment lending into a section that is for investment lending that can be negative geared. And that increases your borrowing power, right? And it gets more significant the higher the income is and the more negative geared debt that you have.
Yeah.
So just to give you a rough idea, on a 400K loan, right, on a average yield, you could borrow with, you only really need 55K, right, to get that if you could negative gear the debt. If you weren't to negative gear the debt, you'd need 75K. So it's for someone who's earning 55 right now, for them to jump up 20K on income overnight because of negative gearing was scrapped, that's pretty significant. But it's on a larger scale with people that have, $1 mil, $2 mil of negative geared debt, like it's even more significant for those people.
Yeah, in that 50 to 75K, that's like the earning example of what they need to earn to get the 400K loan. Is that what you're saying?
Yeah. So if you took away the negative gearing, to get the same loan, you'd need 75K versus 55 with it.
Right. So that's big, because that's what, like almost a 50% increase in income that you have to have there. But why that's important to share as well is that like that has a flow-on effect. That means now a lot more investors won't be able to actually borrow for what they might be looking to invest in.
Or they have interest-only loans that they borrowed when they could use negative gearing, and then when the interest only rolls over to P&I on a shorter loan term, they can't refinance.
Yeah.
Because the servicing is not there.
And see, that comes back to actually impact the investor market too. Now, not just from what they borrow, but what they currently own. And we're seeing that when you apply in Victoria, for example, lots of taxes and costs onto an investor exodus starts occurring, rental stock starts tightening, and then rents start rising. And that's one thing many people will forget. Yes, the market decides the rent, not a tax policy. It's not like you can just go, hey, tax policy is coming in, everyone's going to rack up their rents. No, if the market's got supply there, they're not going to jack up their rents. But that policy has a flow-on effect to people's confidence of staying in that housing market or entering the housing market, especially if borrowing capacity is going to go, less people will enter it. And then suddenly what will happen is that less rental supply becomes available and rents rise. So your whole journey, if you're someone who's on the other side going, I can't buy because of negative gearing, well, each week you're paying rent, right? And as you're paying rent, your rents will likely increase over time because these policies have been removed. The flow and exodus of investors, rental stock reduces. And then now as an investor, now as a tenant, you're going, I want to buy, but you're now not saving the deposit you were quickly saving before because the rent's coming out of your deposit you're trying to save. And you're back to square one, but just in other ways. Like it doesn't have to equal the same way, like as in you now have less competition, you can therefore buy. You now have more competition on the rental side. And so that's an interesting thing that many people don't often realize about negative gearing. The other thing I want to share, Jack, is like CGT.
Yeah.
What do you think happens when CGT, if that were to come off and stop, what do you see happening there?
So I didn't really get across this. So they're talking about removing capital gains tax completely.
I mean, like there's some people who are saying like, let's just make tweaks to these gearing policies and gains tax to investors who own X or more properties. And then others are saying, let's scrap it completely. Now, I'm of the opinion here, I'll share my thoughts. Like if they scrap it completely, you're going to have a whole bunch of people not selling. Because if you just look at it as a business decision or you look at it as a financial decision, whichever way, a business if it's an investment, personal finance if it's a home to live in, if you've got a property that's say grown in 100K in value, increased in 100K in value, and then from a CGT you get the 50% discount after 12 months, and that now comes down to say 50K taxable instead of the 100K, say if someone scraps that, you're now paying double the tax that you were before.
Okay, so
right?
They're talking about removing the discount altogether.
Yeah.
I was going to say, because I thought what you said was they're not going to charge any capital gains tax. I was like, that's off-brand. Come on.
That's off-brand, government. That's off-brand. No. Man, I'm yet to see a day 100%. Where they just chuck out freebies and nothing comes back of it, right? But
why would anyone want to cop that tax bill? Like people have a hard time copping that tax bill now. Like imagine if they doubled it.
Yeah. And all of a sudden, what's going to happen is that people are not going to supply the house with existing supply, supply the housing market with existing supply. Because sometimes people think that it's new builds and everything. If you get new stuff coming in, they'll solve Australia's crisis. Like, funnily enough, it's not the new builds that are needed like the most. They're needed for sure. Don't get me wrong.
It's people selling.
It's people selling just established housing. Like if you take a look at Australia and different segments of markets, so Sydney and Melbourne, their 5-year listing averages and where it is now, some parts of these cities are well above their 5-year average, means there's enough stock to service people who are looking to buy them. Now, go figure, Sydney's quarterly rise has been under 1% in quarterly growth.
Yeah.
And then Melbourne's been flat and in some parts decline. That's an example of supply being available. You go to the other side of the country and you go to Adelaide and Perth, 30, 40% plus. Some SA3 areas have even 50% plus below the 5-year average of established housing for sale. And you're in the same country with the same interest rates, with the same macro outlook, except one city just, a few hours drive, or maybe not a few hours drive from those cities, maybe a few hours flight from those cities, different housing market, like completely different housing market. Their housing's in a big boom right now in Adelaide and Perth, growing more than 1% a month. So that clearly shows supply is the killer there of the two. So if you're going to go and make changes to these taxes, you're going to hold lots of people back from selling because they're going to see the financial part not being worth it for them. And you're just going to kill the supply. And again, the whole point of housing affordability you're trying to create, you're going to have housing affordability come back and be an issue again because you're not having supply come to the market. Even if it's not investors competing, owner-occupiers will be competing on less stock anyway. But that's a couple of things of what our thoughts are on this whole CGT and negative gearing stuff. And all of it, in my opinion, tends to come back to increased costs down the line, but just not immediate. What are your thoughts, though, on the borrowing capacity? That was a big factor there. You've also seen some other borrowing capacity views, though, Jack, when it comes to like people looking at money in their offset or savings accounts and how negative gearing's helped them when they have a home to live in. How does that work?
Yeah, it's big. It's quite common that people don't really know this, and it's a big eye opener for people. So sometimes, they have, surprisingly, people just have hundreds of thousands of dollars in their account. But even if you just have 100K or, 50K just sitting in an offset and you were going to allocate that towards a purchase of an investment.
Yeah.
But if you have owner occupied debt, right, and that's sitting there offsetting your owner occupied debt, if you use that to purchase an investment, you're not able to claim that interest as an investment expense, right? So what some people do, say you've got like a 500K loan, right? And you've got 100K or you got an inheritance for much more, say 300K, you could use that money, put it into the redraw facility of your owner occupied property, tell the bank to take it, reduce the limit of your loan completely and just have a much smaller balance, which means you have a much smaller repayment as well. And then you can cash the money back out as an investment purpose loan. Right. And then you use that as a deposit for the investment property. So not only does it reduce your non-deductible owner-occupied debt and repayment, it increases your investment debt, and there's a better negative gearing aspect to that. So it gives you better serviceability, but it also gives you better cash flow once you do your tax return. There's more negative geared debt associated with the purchase and a much lower expense of where you're living.
That's the finance strategy we were talking about.
Yeah.
So everyone at the start of this podcast, I mentioned reaching out to Jack at forecafinancial.com.au. That is a perfect example of a big difference maker, because now you've had like a 3-tier approach there. You've gotten more deductibility in tax. You've also, which helps your tax returns.
Yeah.
You've gotten more deductibility in terms of like now impacting your borrowing capacity. But then also you've reduced your loan on your home.
Yeah, and if you cash out, say you got 200K, you pay down your own occupied debt, and you cash out another 200K, you don't have to use the full 200. Like you can keep a little bit of a buffer there as an investment buffer, because most people want a buffer, but they assume that it has to be placed against their own occupied debt as savings.
Yeah.
But really, you can build in your cash buffers to your investment cash out loans, and there's a better outcome there tax wise as well.
Well, that's a killer approach, because so that's a really good approach. I actually did something similar in 2020, 2021 when COVID first struck. That obviously scared many people, like what's happening, what's going to happen in the world. And those with equity in their investment properties or homes, they're able to cash out, leave it sitting in their buffer accounts, and suddenly you're well insulated to ride out. And this is something many economists and many doomsday forecasters don't get right, because they just don't recognize how much equity exists in Australia. It's over $10 trillion in housing value and just over $2 trillion in loans. So if the income allows the serviceability to cash out, there's a lot of people sitting on it. Also, in terms of resale value, there's a lot of opportunity for people to resell and clear all their debts.
That's right.
And so from that perspective, this means that when events happen like this, people should learn after multiple times, whether it be interest rates rising, whether it be GFCs, or whether it be huge economic shifts, the dot-com bubble burst, or whether it be COVID hitting our shores. Time and time again, Australia is going to be well insulated because of the equity that exists in Australia, where 20% of housing or 22% of housing's actually got leverage, and more than 2/3 of housing is owner occupied. Right? People are not going to use this as a financial tool or vehicle. They're not looking at this as a business. They're sitting there and going, "It's my house, mate. I'm watching the telly. Can you leave me alone?" Like, they're just chilling out. It's there. I'm paying for it. I'm good for it. So, just those sorts of things make it massive that people can access these and create buffers. On the topic of buffers as well, quick tip for anyone tuning in here is that at InvestorKit, we believe having 20 to 25K buffers per property is a great buffer to have. So quick back of the napkin, if you've got 4 properties, treat $100,000 as your buffer. So then you tell yourself, hey, I've got 100K, that's my zero. And every $1 above that, you're able to then invest and go, okay, now let my money work for me. And as Jack mentioned, that doesn't have to happen from your hard saved cash. It can happen from equity out loans, preserving some in the offset. So you've got 100 sitting there as a way to, grow the portfolio, but not feel so tied to what happens to interest rates, what's in the media. Buffers are a great tool. They're a mindset tool, not a risk management tool, because usually if your mindset opens the CommBank app and goes, not too shabby. You'll probably get on with life. You'll probably ignore the headlines, and you'll likely make better decisions too. So that's just my thoughts on the buffer part. But Jack, anything else to add on the gearing sides of things from a finance side of review?
No, I just wanted to add that if you've got equity, generally you shouldn't be struggling, because it's just a knowledge gap of people not knowing that you can cash out for a buffer and even use it for repayments on investment loans. It's just a knowledge gap, but it can really unlock a lot of things. Some people are at really low LVRs, but they're servicing everything with their cash, like their own income. And it becomes really hard, especially since they've been doing it for quite a while. But if you've got equity, generally you should have options. Yeah.
And the rules and different options will vary from bank to bank, and that's where you come in to be able to unpack that all, right? So look, that's our thoughts today on negative gearing, CGT, what's happening in the markets. Firstly, summarizing it, borrowing capacities will take a hit if any of these changes come through. Second thing is trust will maybe go out the window as even a strategy to begin with if CGT and gearing happens. And look, what about all the political guys with their family trust, stashing stuff away? So I reckon, I don't know if they're going to shoot themselves in the foot, are they? No. And then the third part is rents will increase as a result of all of these policy changes because it reduces investor participation. And that's not good news for many people. And lastly, when it comes to thinking of finance strategy and thinking of gearing, thinking of deductibility, here are some of the things to consider, which involve the cash you hold, the buffer you hold to get you ahead. So rewind back if anything of that was helpful in a finance strategy aspect. As I mentioned on the Property Nerds, we're going to be doing a lot more of that just because we know property isn't just property data. It's a lot to do with finance strategy. So unpack that with Jack and go from there to be able to dig deeper into the spreadsheets and the numbers that I share, but with a finance element too. So catch you all on the next episode of the Property Nerds podcast. And that's CGT and gearing thoughts from us. A lot of flow-on costs, a lot of flow-on decisions that just don't seem like the smartest thing to do in our opinion.
Game over.